Bond market might be closed today, but it's been an amazing week for yields, which have surged on the back of Donald Trump's victory. Our next guest called Mr. Trump's win and the move in rates months ago. Jeffrey Gundlach is the co-founder and CEO of DoubleLine Capital, with us today live in Los Angeles. It is a halftime report exclusive. Jeffrey, welcome back. It's nice to see you again.
Thanks, Scott, and a shout out to all the veterans here on Veterans Day. Thanks for all your sacrifices, and we always look forward to November 11th here at the firm, because 11/11, that's two double lines.
Well said. Very, very well put. So you thought Trump would win. You thought rates would rise, but did you think they would rise in the magnitude in which they have this week?
Well, I don't know about in this compressed time frame, but back when we turned maximum negative on treasuries, which was July 6th, when the treasury was at 132, unbelievably, we got it to the day and the basis point. We said in the webcast just a few days after that in July that the 10-year would be above 2 before year end. And by the way, I have another webcast on Tuesday on asset allocation for fixed income, so people can register for that at DoubleLine.com. But yeah, we expected the 10-year to go above 2, and but the 35 basis point move since the election is not that surprising given the narrative that's developed about the Trump victory. So I do think this rate rise is about 80% through, at least this leg of it. I think we have really critical resistance on yields, up at about 235 on 10s, maybe 180 on 5s, about 1.1 on the 2-year, and we should get a tradable rally off of that level. If we don't, then things are in really big trouble, because the rate rise so far is sufficient to start having a little bit of economic impact, not so big yet. But think about how interest rates have been sort of at that 2% or lower level on the 10-year for so very long. I mean, think about the residential housing market, where so many mortgages have been priced out at 3% over the last many years. And what happens if mortgage rates go up further from what they've gone up so far? You'd be looking at monthly payments to prospective home buyers that would be something like 20–25% higher than where they were at the embedded lower yield levels, which just has to lead to, if it happens, some correction in pricing in the residential housing market. And also, if yields break up above that resistance point, you're going to see some impact on some of the financial engineering and buyback activity, I would think, in the equity market. So this is getting to be a critical level. I remember way back, Scott, in pre-taper tantrum, we talked about the 235 level on the 10-year as being important. I don't know if you remember that. That was quite a while ago, over 3 years. But when it broke above 235 in May of 2013, you blinked and it was at 275. So I think we have a little bit more to go on rates moving higher, but we should, we should and hopefully will get a tradable rally off a level not too much higher from here.
Well, what's a reasonable yield to expect by the end of the year, putting the Fed into the context as well?
Yeah, I think that we will see yields a little bit higher than where they are, but I don't think we're going to get above 235 by the end of this year. One of the reasons I was negative on bonds in July was that the inflation expectations that were priced into the TIPS market, when you compare the price of Treasury inflation-protected bonds to nominal bonds, the inflation rate was sort of insanely low that was priced into the markets. I mean, CPI is driven at the headline level partially and significantly by movements in WTI. And the year over year on WTI is not going to be zero or negative anymore, even if oil just stays where it is today. I mean, oil bottomed out in January at about $26 a barrel. Let's just make the math easy and say that come January, late in January, WTI rallies a little from here and makes it to 52. That would be a 100% year over year increase in the price of oil, which to our analysis at DoubleLine would correlate to a 3% year-over-year CPI. Now, here we were in July with break-evens on tips to nominals at like 1.5%. There's just no way that you're going to be able to keep those inflation expectations nailed down at 1.5% when you're when it's staring you in the face that year-over-year CPI on the headline is 3%. So I think this is a really interesting time in the markets for thinking about inflation expectations and what's rational pricing. And so it's going to be really a kind of a fun time to be managing money over the next 6 months, because the times there are changing.
So it's so interesting for someone who said that at one point, not all that long ago, that the stock market was whistling past the graveyard. You also said recently that if the S&P had closed below 2130 twice, that it was a negative sign. Now the S&P is at 2163. The Dow's knocking on the door of 19,000. Are you more optimistic now about the stock market, or is that optimism tempered because of this swift rise in yields, which could eventually put pressure on a whole bunch of sectors?
Yeah, I'm basically have a wait-and-see attitude about the stock market right here. When we did get those two closes below 2130, we ended up having 9 down days in a row that culminated in something of a crash overseas when the news was getting apparent that Trump was going to win. And that did turn out to be a buying opportunity. But right now, the market is in no man's land. I think you have sort of a 2,200 type of ceiling if you look at the charts, and you have like a 2,100 kind of a floor. And now we're sort of right in the middle. And the way I'm thinking about the stock market is let it prove itself either way. If we get a couple of closes above 2,200, then the bulls are right. And if we go back down, close back below 2,100, then probably something's going on with rates getting out of control. And so I just think if the stock market's cheap at 2163, then it's also cheap at 2,200, and I would wait to let it prove itself to make it up to that level if it's really for real. But I do think sectors are getting very important in the stock market. One thing about Trump's win is there's something about it that people just want something real. They want to see things being made. They want to see policies being changed. They want something real, no more of this man behind the curtain stuff, which means that the financial engineering stocks and the momentum stocks, and I would say like the FANGs, I would stay away from them in a big way. I think if you're going to buy the stock market, you want to look at stuff that's real. And I know that its trade location's terrible, so I wouldn't do this today. I was listening earlier on in the program to people talking about the massive move in things like industrials and financials this week. Clearly, you'll get a pullback from these levels. But I do think industrials, materials, and financials are the sectors, things that are real. Are what you want to be invested in. And I'm feeling very strange because I've been negative on financials for 10 years. And I've been negative on tips in the bond market for 10 years. And as of 2 months ago, I turned very positive on both of them. And financials I like for the obvious reason. It's a real simple thesis. I've heard it on CNBC over and over again. I agree with it. The yield curve has been steepening. It's positive for financials. And of course, the Trump win around the edges means less pressure on regulation of banks, which has to be a positive. So the moves this week are very, very big, but they're justified. But for the long term, is what I'm talking about. Not for the short term, where I think these moves are just really, really overdone.
So then you would be an obvious fader of any yield play, so-called yield play, a utility, a telecom, a staple, a REIT. Is that what I'm hearing?
Well, it's interesting you mentioned REITs and utilities. When I spoke at the Ira Sohn hedge fund conference back on May 4th, my recommendation to Ira Sohn was to go long REM, which was the ETF for mortgage REITs, and go short XLU, which is the ETF for utilities. That trade has already worked. I recommended it on a one-time leverage. It's already a 30% winner. Utilities since then are down 5%, and the REITs are up 10%. The S&P 500 has massively outperformed the utilities since then. I'm just suspicious of yield plays broadly because of the tremendous crowding of that trade at mid-year, although I'm less suspicious today. One of the reasons that I turned so negative in July was the incredible offside positioning, in our view, in the bond market. Inflation expectations were ridiculously low, and speculative positions in bonds were an all-time high. The short position in the TLT was at an all-time low. I mean, this is a really offside trade. The good news for bonds, and why I think this yield move is 80% over, at least on this leg of it, is that crowded trade is not crowded anymore. The speculative positioning long on bonds is completely gone. It's been that speculation has been removed. And so the positioning is a little bit better. But I do think that why yields will rise a little bit more is we're seeing, we manage a lot of money and we have a lot of bond funds here at DoubleLine. We've seen a lot of institutions and a lot of consulting platforms decide that their enthusiasm for bonds was too much, and they've allocated money in the last couple of weeks, and particularly this week, from bonds to stocks. I think that's one of the main reasons, I shouldn't say main reason, that's one of the reasons why stocks are so strong right now, is there's been a positioning away from bonds into stocks. And I'm telling you, we see it at DoubleLine in size. And so I think that's fueled some of this move, but it's not going to go on forever. And I think that when you move yields a little bit higher, I think that positioning is ill-advised. I do think that there's a tradable rally coming.
Let me slip in a quick break if I could, Jeffrey. We'll do that, and we'll come back on the other side. We'll talk more with DoubleLine's Jeffrey Gundlach after this. Jeffrey Gundlach is the co-founder and CEO of DoubleLine Capital, with us live today in a halftime exclusive from Los Angeles. Jeffrey, let's talk about the Fed in a couple of different contexts here. Number one, do you think the Fed will, in fact, definitely go in December? And also now, if the Fed believes that it no longer is the only game in town, if there's going to be an infrastructure spend, if there actually is going to be some fiscal stimulus, whether you think there could be a risk that rate increases could be at a faster pace than some people think as the Fed tries to get out of the way?
Well, first of all, if the Fed doesn't raise rates in December, they're never going to raise rates again. I mean, the bond market is giving them carte blanche to raise interest rates, with rates going up 83 basis points on the 10-year since July 6th, and the comparison of yields in the bond market at the short end suggesting there's an 85% probability that the Fed's going to raise rates. So December seems to me that the Fed absolutely should raise rates in December if they plan on ever raising them again. So this idea of will they accelerate the rate increases with fiscal stimulus is an interesting one. But first we have to see if the fiscal stimulus actually takes shape and if it actually has any effect. I mean, one way to do fiscal stimulus is to take people who are on welfare, receiving welfare payments, and say, we're not just going to give you money for being on welfare, we're going to tell you to go into your backyard, dig a hole, and fill it in, and we're going to give you the same amount of money, but we're going to call it a job. Obviously, that does nothing in terms of moving the economy. However, if you get a fiscal stimulus that actually builds things like walls and airports and bridges and brings people who are underemployed or part-time employed into the workforce, and they get more money from their job, then I think you do have fiscal stimulus. But I think we're way ahead of ourselves on this. It's easier said than done, and we're not sure what exact form it's going to take. You remember the shovel-ready jobs, where they haven't even made the shovels yet, and when they make them, they'll probably be made in China. But the shovel-ready jobs didn't actually lead to much in the way of economic growth. So I think it's possible it'll work. We need to let it take form. And this is another reason. I just think my broad context here, Scott, is I think these moves that have happened are justifiable. I think that they were predictable. We predicted them at DoubleLine.
You sure did.
I think we're more near the end of the near term of the sort of knee-jerk reaction to these things. And now comes the hard work of actually trying to see how it gets implemented. So could the Fed try to balance off fiscal stimulus? Well, that's kind of counterproductive, isn't it? I mean, so okay, fine. All you've had is the Fed with the gas pedal, and now you've got little help with another gas pedal. And is the Fed just going to instantly try to counterbalance that by hitting on the brake? What's the point of having one foot on the pedal and one foot on the brake? Why not? Why bother? You're going to ruin your brakes and you're going to burn all your gas. What's the point? So I think the argument the Fed will try to offset the fiscal stimulus is a bad one. Could they raise rates a couple more times? Sure, because one thing that people are kind of missing is that nominal GDP. One of the reasons, again, why we turn negative on the bond market is nominal GDP is an excellent proxy for where 10-year Treasury yields should be. And nominal GDP could be up at around 5% when you get to maybe April of next year. Maybe you get 2% real GDP, which we sort of have going on right now. I know last quarter was 2.9 thanks to a huge soybean export. It was really 2.0. I think, let's just say we're running around 2.0 real GDP. Some people might argue higher than that. That's fine with me. But let's just take 2.0. And you throw maybe a 3% inflation rate on that. Heck, you're looking at a 5% nominal GDP. What in heaven's name are 10-year Treasury yields doing at 150 if we have the potential for 5% nominal GDP? So I think we have a tradable rally coming in the bond market, but there's a potential for another leg up in yields when we get into 2017. And I've said over and over again, ever since July of 2012, I said I really think history books will say July of 2012 was the orthodox low in bond yields. I know that the 10-year Treasury got a couple basis points lower in July, but then it rejected it. That was a horrible chart formation. And so back in July. And so I think that we have a tradable rally, but I think we're going to get another up leg in yields when we get to 2017.
So let me ask you lastly before we go, your view on gold, and also in the context of what Stan Druckenmiller, a brilliant investor, told Squawk Box this week.
Stan's the best.
Certainly one of them, if not the. That he was out of gold now, and that he was short bubbles, in his words. Short boons, gilts, Italian bonds, U.S. bonds. I'm wondering in how that shapes with your view of how to trade this today.
I'm pretty much in sync with that. I'm certainly short the bubble concept. I think the FANGs are a bubble, frankly. And I think that they're all based upon the past, which changed on Tuesday. And so I think things that are real make sense. Gold, I don't think is a great place to be right now. It's sold off a lot recently. I'd wait for a rally to short it, but I'm not really long-term as optimistic on gold now that Mr. Trump is taking over the White House.
Jeffrey, can't thank you enough for the time you've given us today. Thanks so much for coming on the Halftime Report.
Thanks, Judge. Good luck to everybody for the rest of the year.
All right.
Thank you.
Jeffrey Gundlach, Bond King, maybe now the Election King, too. We could add that to his resume of DoubleLine. We'll be right back.